So, you're thinking about investing in a company. That's awesome. But before you jump in, you kind of want to give that company a quick health checkup, right? Well, in this explainer, we're going to break down exactly how to do that. We'll give you the tools to look right under the hood and see what's really going on with the money. Let's get into it.
You know, the legendary investor Warren Buffett himself said that accounting is the language of business. And he's not wrong. I mean, if you want to understand how a business is really doing, you've got to learn how to speak its language. These financial documents, they tell the whole story.
But let's be honest, for most of us, looking at a financial statement feels like trying to read a foreign language. It's just a wall of numbers, and it can be super intimidating. But here's the good news. You absolutely do not need to be an accountant to get the basics. You just need a little translator, and that's what we're here for.
To do our company health checkup, we really only need 3 main diagnostic tools. Just 3. And these 3 documents, when you look at them together, paint a surprisingly clear picture of a company's financial health.
So what are they? Well, our 3 tools are the balance sheet, the income statement, and the cash flow statement. Each one tells a unique and really important part of the story. We're going to kick things off with the balance sheet. All right, first up, the balance sheet. The most important thing to remember about this one is that it's like a snapshot, a single picture taken at a specific moment in time. At its core, the balance sheet is all about answering one big question. What is this company's net worth? Right now, on this specific day. Think of it like taking a financial photograph of the business. So the balance sheet gives us that snapshot by listing out everything a company owns, everything it owes, and what's left over for the owners. That's why you'll always see a specific date on it, like as of December 31st. It's not for a whole year, just for that one day. Now, this little formula you're seeing, this is the golden rule of the balance sheet. It might look like scary math, but it's actually pretty simple. It just means that everything the company owns, its assets, had to be paid for somehow, either with money it borrowed, that's liabilities, or with money from its owners, that's equity. It always has the balance. Hence the name, right? Let's break that down even more. Assets are all the good stuff the company owns that has value. You know, cash, the products on its shelves, its buildings. Liabilities are what the company owes to other people. Things like bank loans or bills it hasn't paid yet. And then equity is what's left over for the owners. You can think of it as the company's net worth. Okay, so as a potential investor, what should you actually look for? Well, first, check out the assets. Are they solid things or kind of flimsy? Second, look at the debt. Is the company drowning in loans? That can be a huge red flag. And third, can it cover its bills for the next few months? That's what we call working capital, and it's super important. All right, on to our second tool, the income statement. Now, if the balance sheet was a snapshot, the income statement is more like a video. It shows you what happened over a period of time, like a whole quarter or a full year.
The income statement is designed to answer one simple but, incredibly powerful question. Is this company actually making any money? It's all about profitability.
This statement, and you might hear it called the P&L for profit and loss, it just adds up all the money the company brought in, the revenue, and subtracts all the money it spent, the expenses, over a period. Honestly, it's kind of like your own personal monthly budget. What came in, what went out, and what was left at the end.
The layout is really logical. It starts at the very top with revenue. That's all the money from sales. Then it subtracts all the costs of doing business. And what you're left with, way down at the bottom, is the net income. You've heard people talk about the bottom line, right? Well, this is it. So when you're looking at one, what should you keep an eye on? Well, for starters, is revenue growing? You want to see sales going up over time. Then, look at profit margins. How much of every dollar in sales does the company actually get to keep? And finally, are their costs under control, or are they getting out of hand?
Okay, now this next part is absolutely crucial. This is a trap that a lot of new investors fall into. You have to understand that a company can be profitable on its income statement, but still be running out of cash. And you're probably thinking, how is that even possible? Well, it's because profit is not the same thing as cash in the bank.
Let me give you a quick example. Let's say a company makes a huge sale for $10,000. The customer says, "I'll pay you next month." Now, on the income statement, the company gets to record that $10,000 as revenue right away, making it look more profitable. But has any actual cash come in the door? Nope, not a dime. And that is exactly why we need our third and final tool.
And that brings us to the cash flow statement. This is where we stop talking about accounting tricks and start following the actual cold hard cash. This statement shows you where money really came from and where it really went.
The question this statement answers is vital for survival. Is the company bringing in more cash than it's sending out, or is it just burning through cash? Because at the end of the day, you can't pay your bills with profit. You pay them with cash. Cash is king.
The cash flow statement breaks everything down into 3 buckets. First, operating activities. This is the cash from the main business. You really want to see this number be positive. It means the core business is healthy. Then you have investing activities, like buying new buildings or equipment. And finally, financing activities, like taking out a loan or paying money back to shareholders.
Okay, phew, I know that was a lot to take in, so let's pull this all together into a simple, one-page cheat sheet to make sure it all sticks.
So here it is, the whole shebang. The balance sheet is a snapshot of the company's net worth. The income statement is a video showing if it's profitable over time. And the cash flow statement? That's like the company's checking account, tracking the real cash. When you look at all 3 of these together, you get a powerful health checkup on any company you're looking at.
So there you have it. You now have the basic tools to start speaking the language of business. And remember, these statements aren't just numbers on a page. They tell a story about where a company has been, how it's doing right now, and maybe even where it's going. The only question left is, what stories will you find?